What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked number one on Wall Street in the 2024 All America Institutional Research Survey. In this week's episode, we'll be discussing the importance of PMIs and why they are a must-watch data point in 2025. I'll be speaking with Stephen Gregory, my long-term colleague, who heads up the quantitative research effort at Piper Sandler. Hey, Stephen.
Hello, Michael. Let's talk about PMIs today. So they're an important part of our process. We talked about them in our Outlook podcast a few weeks ago. But before we kick off and talk about where we see them going, you want to tell the audience what a PMI is?
It is an acronym which stands for Purchasing Managers Index. So it's a survey of purchasing managers all over the country when we talk about the national PMI data. And there are two surveys. There's a survey that asks questions to purchasing managers in the services sectors. So think of retail, leisure, hotels, restaurants, et cetera, for example. And then there's another survey that's probably more popular, which is the manufacturers purchasing managers index. And that obviously goes to manufacturers in the country. And so these two surveys capture the two segments of the economy that explain the business cycle. Obviously, the US economy is far more services oriented, though we tend to find there's a lot more information in the content from the manufacturing data. And manufacturing is as old as time. Current new president Trump is very focused on rebuilding manufacturing, and he's using tariffs to help improve the trade deficit. And he talks about all the reasons we need to increase manufacturing in the United States. They are as old as time. You can go back to Alexander Hamilton's, which you could argue is the father of U.S. manufacturing, his paper in the late 1700s, which was titled, this is a really sexy title, Stephen, The Report on the Subject of Manufacturers.
That's not going to get many clicks.
No, definitely not. But when you look at that very long paper, that was written in 1791. Alexander Hamilton, who was Treasury Secretary at the time, was talking about all the reasons the U.S. economy needed to diversify away from just an agricultural economy, which of course was the big sector back in the 1700s, to a more manufacturing-based economy. And when you look at the rationale he gives, it's not dissimilar from what we're hearing today. It's about national security. It's about economic diversification.
There's a lot of different PMI indices out there. There's regionals, there's an S&P does one. The ISM is a popular one that's been around for a very long time. They all have slightly different construction and definitions and components and weightings. Let's focus on the ISM, which has been around since the 1940s. It's a very popular one. It's one we use a lot. You want to talk a little bit about what the scoring represents and what the underlying construction is?
Sure. So with the ISM, which again stands for the Institute of Supply Management. So this is the organization that collects the data for the ISM that's reported every month for services and manufacturing. Okay, so when we look at the manufacturing ISM, there are 5 components, and they essentially touch on each important part of the supply chain. So the first component, which we would argue is probably the most important one, is the one called new orders. So each month that these purchasing managers are asked whether or not their new orders increased in the current month versus the prior month. The next component, if you think about the supply chain, once you get an order, we have to build it. So the next one is called production. And then after that, there's employment. Then there's something called supplier deliveries, which touches on how quickly basically these goods are being delivered and the timeliness of the supply chain. And then lastly, of course, there's inventories. So just like an analyst would go to a company and ask the management, are you guys getting more orders? Or what are your production capacity? Are you hiring? What are your inventory levels? How are you getting your goods to your customers in a timely fashion? This ISM index provides the macro equivalent for that on a national scale.
So you're asking these questions to individual companies, which make a lot of sense. That's what I'd ask a single company if I was doing fundamental analysis on it. And you're asking the question, is it better, worse, or the same today from last month?
Yeah, and it's actually very simple. And that goes to the simplicity of these PMI or ISM data, is that they're just basically diffusion indices, and the compiling a bunch of answers of folks saying whether or not these components got better, stayed the same, or got worse. So When you look at the output of these surveys, they tend to be basically rooted in the idea that a 50 reading is a reading that suggests that really nothing changed, or there's an equal dispersion of purchasing managers saying things got better and things got worse. So the headline indices is the composite of those five components of new orders, production, employment, inventories, and deliveries. And that's the number that's often reported in the financial media each month, usually at the beginning of the month for the ISM manufacturing data.
So a 50 represents nothing has changed. It could be nothing has changed from a really high level of the economy or a really low level. Doesn't mean 50 represents zero on GDP, let's say.
Correct. Exactly. And that's, that's the difference between a number like GDP growth, which is taking the growth rate on an aggregate economic data set, whereas the PMI surveys are a diffusion index. So all they tell you, whether they don't tell you how good or bad things are, they are only telling you whether things are getting better or worse from a starting point. And you don't know necessarily where that starting point is, which is why you have to take these PMI data with a grain of salt and corroborate them with other activity data in the economy to help you understand what the starting point is. You can improve from a really booming economy and you can deteriorate while still in a recession. And so these PMI data, again, are useful, but more from a rate of change rather than a full understanding of what the economy, how strong the economy or how weak the economy is.
Great. So we've talked a lot about manufacturing PMIs, and I can hear the question right now because in the 20 years of you and I doing this, Michael, we've heard this question from clients. US is a services economy. Why are you looking at manufacturing?
Yeah, so indeed, the US is very much a services economy, increasingly so by some metrics. However, when you're looking for volatility in macro data and inflection points and cyclicality, when we think about the business cycle, it's not the services economy that creates the business cycle. It's not very cyclical. Services activity are quite stable, which is why the US economy is quite a stable economy compared to other more manufacturing oriented economies. Think about emerging markets or even China. And so when you think about where you can find more information content, when you're thinking about looking at services data or manufacturing, it's not just the size that matters. It's really the size times the volatility, which the product of those two will give you the contribution of the data in terms of the change in the data in the economy. So let me give you an example, actually, kind of make a parallel to this point. In the CPI readings, energy is a really small part of US CPI. I think it's only maybe 6 or 7% of the weighting in the monthly CPI data. However, the volatility of oil prices and gas prices and electric prices, so the volatility of the energy component is really, really high. So though energy is a small weighting in CPI, when you regress the energy component with the overall CPI component or the overall CPI data, it actually explains something in 80% of it because it's so volatile. Thus, the contribution of energy to the overall CPI in terms of its incremental change is quite high. And so that's the same in the case of looking at manufacturing activity and its contribution to the incremental change in economic data or activity from month to month.
Perfect. So I think that's a great high level explanation of what PMIs are, how they're constructed, what the 50 means, and why we look at the manufacturing a little more than services. It explains the change more, and they're really a gauge of momentum. I think it's a perfect segue into interesting for the economy. Why does it matter for markets?
So it matters for markets, and the last couple of years there's been a lot of controversy around the manufacturing PMIs because they've been so weak. Yet the overall economy and overall stock market have, on the surface, looked completely fine. And again, this goes to the differences in the construction of these data points and what they're focusing on. Again, GDP for the overall economy is a really broad number, and again is also a number that represents how strong the economy is, not necessarily incrementally how much it's changing for the better or worse, like these PMI surveys are. In the last 2 years, though, we've also seen this big bifurcation between manufacturing and services PMIs. And you've seen this bifurcation also within the market from small and large cap earnings, for example. So the Fed tightening cycle that took place in 2022, while it didn't create a recession, it did certainly hit many economically areas of the US economy, like small business, and manufacturing activity, which showed up in really bad NFIB data, which is the National Federation of Independent Businesses. So that's a monthly small business survey. And it showed up in PMIs, manufacturing PMIs that were in contraction for nearly 2 years. And there's been a lot of debate around, why we had such a bad PMI and we didn't have a bad economy. And many people just said, well, the PMI must be broken. The manufacturing PMI must not work anymore. And our take is more that it's not broken. Perhaps people were expecting or asking too much of it essentially, or maybe relying too much on one data set to entirely give us the picture of the full economy. And so the manufacturing index, again, represents the real cyclical part of our economy, which definitely did struggle for a couple of years. And now, for the first time in the wake of the Fed cutting rates 100 basis points, we've seen manufacturing activity in the ISM index break into expansion territory for the first time in over 2 years. And so, what that means for the market is that it doesn't necessarily mean that the economy is strengthening the way it could mean that. But the way I would think about it, especially in the context of the last few years, is that it's really the breadth of the economy improving. And I think there's a really important nuance to appreciate that there's a difference between breadth and improving breadth in the economy and improving strength in the economy. And again, the last 2 years, we saw this in the stock market. S&P 500 was up over 20% 2 consecutive years, but the breadth of that strength really was very narrow and it came from largely 7 stocks. So that's a good return if you own the index, but if you've been a stock picker and you are more basically exposed to breadth, your performance was probably not nearly as good as the index. Or from an economic perspective, yeah, the economy's been great overall for the last 2 years if you just look at nominal GDP. But if you've been a small business or low income consumer, you've probably felt a lot worse than those aggregate numbers appear.
So it's really a gauge of how broad the economic strength could be in the year ahead. I think that plays in perfectly with the idea of we've been generally stuck in that range bound 50-ish, slightly below area. And you've seen that exactly in markets. As you mentioned, there's been a few companies that had incredible earnings, and because of the cap weighting of indices, those have accelerated. But if you took the entire S&P, like the 1500, the broader US S&P index, and looked at their 2024 earnings growth, it's almost perfectly split with half companies growing earnings and half of them not. And I think that goes to your breadth idea.
Yeah. So the key takeaway from an improving manufacturing PMI in 2025 is that that suggests from a top-down perspective that we should likely see more companies participate in this strong economy, that the breadth of companies seeing positive earnings revisions should be increasing as the PMI goes up. And that's really important for markets because over the last couple of years, investors have been really focused on market breadth. And there's been a lot of false starts to sustainable breadth in terms of equity performance. And I think the large reason that's been the case is that what really produces a market backdrop of strong breadth, price breadth, is when you have strong fundamental breadth. And that's been absent for the last 2 years. So that's why small caps have underperformed. That's why the Mag 7 has explained the bulk of the returns of the S&P 500. But as the PMIs improve, that suggests that we should start to see fundamental breadth widen and broaden out, and therefore market breadth finally and sustainably broaden out.
So if we do see better breadth in the year ahead, that would likely have a big impact on leadership. A lot of the leadership we've seen has been because earnings breadth was scarce. So you fly into these names that have earnings and the rate of change in earnings. A different landscape and kind of some of the leadership changes that a lot of people have been calling for and haven't materialized.
In 23 and 24, our recommendation was to own an overweight profitable growth stocks. And it was largely because of the reality that earnings were bifurcated and manufacturing PMIs were in contraction. And now that that's starting to change and our forward-looking indicators suggest that could continue for much of this year, it's time to think about repositioning for a different macro backdrop in 2025 because it is absolutely changing. And the need to overweight growth companies while manufacturing PMIs are starting to improve starts to decay as scarcity of earnings growth starts to dissipate And that's why at the beginning of this year, we talked about moving from quality growth stocks to more quality cyclicals and quality value to basically try to reposition for companies that are going to be benefiting from this improvement in fundamental and macro breadth.
So we made that change on the back of this idea that we thought PMIs were going to accelerate. And maybe you could talk a little bit about it because we do believe it's a unique backdrop. It's not likely to be 2009. You could talk a little about that to pull this whole conversation together.
Sure. Yeah. I think if you look at the last several years and look at the ISM manufacturing index, you'll see somewhat of a U-shaped type of pattern that's starting now that we're back into expansion. You're starting to see the recovery part of that story or the right side of that U. Basically, in 2022, we had a pretty sharp decline in manufacturing PMIs, and some of that had to do with the post-COVID environment. Some of it had to do with the inflation shock and the stock market declining, and some of it had to do with the fact that the Fed raised rates pretty aggressively. And so all of that weighed on manufacturing PMIs in 2022 and 2023 and 2024, and now we're finally starting to see them improve. And we've got about a dozen or so different tools that help us forecast where these major inflection points take place. And the bulk of them today have been telling us, and this is why we changed our call in 2025, that this is the time where you should start to see a sustainable upturn in the breadth of macro and fundamental earnings data, i.e., the manufacturing PMIs should start to rise. And we think this is going to be a story for the entire year. So it's against the lagged effect of Fed easing. It's the fact that global central banks around the world have been easing. It's the fact that commodity prices have been low. And so we've basically gone from a world of tightening to pausing to now easing. And those benefits of the easing around the world are now starting to show up in some better cyclical economic data.
And one of the things we always say is the sustainability of a recovery or any kind of leadership change always are going to come to the data and earnings, and everything else oftentimes just materializes in price breadth that can be here today and gone tomorrow. So with our outlook for PMIs in 2025, what kind of investment themes do you think are going to be represented there? You mentioned pulling in quality cyclicals. Is that your typical positioning framework in a PMI recovery?
A little yes, a little no. Certainly moving to the value side of the spectrum away from growth is typical. I would say the quality aspect of it, though, is more the atypical story that we're telling this year. And so one of the differences today, when we look back at past periods where manufacturing PMIs were going from contraction to expansion, that typically coincides with a backdrop where credit spreads are wide initially, and then as manufacturing PMIs improve, start to tighten. And that gives you a market environment where you get a combination of improving earnings breadth and rapidly rising multiples, which of course is the best backdrop for equities. And the best backdrop for equities tends to be one where investors take on a lot more risk in their portfolio because there's a lot of confidence built up from this broad-based improvement in earnings and market multiples and equity multiples. And so in 2025, we think you're going to get half the story in that PMIs are going to improve, and that's going to lift fundamental earnings breadth, and that's very important. However, in this cycle, given that credit spreads are already sitting at 25-year lows and multiples for equities have already gone up very sharply in the last 2 years, and I'm not just talking about the S&P 500, even the S&P small cap 600 has gone from 11 times earnings in October of 2022 to nearly 16 times earnings as of very recently. So we have seen multiple expansion across equity markets, and that's largely a reflection of the investment community pricing in less risk. The last couple of years, the risks have been inflation, interest rates, and Fed tightening and recession fears. And with credit spreads near 25-year lows and multiples quite high, it's, I think, fair to say that there's not a lot of that risk priced in anymore. And so as we look ahead for this year, we don't want the typical playbook that investors typically gravitate towards in a PMI recovery that coincides with tighter spreads, which is a very risk-on, low-quality playbook. Instead, we want to be focused on cyclical areas that can see fundamental improvement alongside a broader backdrop for the macro story, but acknowledge that spreads are really tight multiples are already really high, and we're probably not going to see a lot of multiple expansion this year, and therefore avoid some of the higher beta, lower quality areas that really require a tightening of credit spreads and a liftoff in multiples to outperform as they typically do in PMI recoveries. But again, this is certainly one that is unique today.
So with credit spreads so tight, unlikely to get a lot of change in multiples. It really comes down to earnings and earnings breadth, which is what PMIs are such a great proxy of. Great reason for investors to keep their eyes on PMIs in 2025.
Absolutely. And that really goes to one of our favorite charts, which is just, again, the ISM Manufacturing Index plotted with the percentage of companies in the S&P 1500 with positive earnings estimates. They are extremely positively correlated, probably highlighting the importance of manufacturing PMIs for understanding fundamental equity breadth. And that is something that is not broken down and remains as tightly correlated as it was 20 and 30 years ago. And so we do feel real confident that this rising PMI story will lead to better fundamental breadth, but just warn investors not to get over your skis in taking on too much risk, because financial markets have already largely priced much of that risk out over the last 2 years.
This is great, Michael. Thank you for teaching us about PMIs today.
Thanks for tuning in to today's episode of What's Next for Markets.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.